Let's kick it off with one of the smartest people out there, Apollo Global Management Chief Economist Torsten Slok. Love the stuff and the data that you and your team put out, Torsten. One of those is this. Earnings expectations for the so-called Magnificent Seven have gone up. But for the other, say, 493 S&P 500 stocks, they have not. How do we read that?
Well, the key issue here is that since the beginning of the year, we've seen a very bifurcated market, obviously. And it's not only in terms of performance, but what is also very important to remember is that it's also in terms of earnings and also in terms of profit margins. So exactly as you're saying, Brian, as the chart shows, you've seen in the dark blue line at the top that earnings expectations to the Magnificent Seven have been going up since earlier this year. And at the same time, earnings expectations to the S&P 493 have been going down. And the same thing is the case if you look at the same chart for 2026. So the first conclusion is the market is coming to the conclusion that in the S&P 500, we all walk around and say, oh, earnings have been revised higher.
Yeah.
It's all driven by the Magnificent Seven, whereas for the S&P 493, it's not so much. And that is also the case for profit margins, also revised up for the S&P 7 and revised down for the S&P 493. And
I'm going to use Thanksgiving as a terrible metaphor for this, Torsten, and bear with me on this one because I hope it makes some sense. Tell us what's more important. So the 493, they're all the sides, right? They're the stuffing and the mashed potatoes and the dressing and whatever it is. The Mag 7 is the turkey. And if the turkey's good, I don't know if anybody's going to care how the other things come out. I think you get my broader point. Does anything else matter except the 7 or 8 stocks that we are showing on our wall right now?
You are absolutely right, but the turkey has been growing in size. The turkey now makes up 40% of the market cap in the S&P 500. It is very unusual to have such a high concentration, and that is the core of the problem for investors today. If I take out $100 fresh, am I willing to take the risk of essentially putting them all into the Magnificent Seven because the Magnificent Seven now has such a high weight? And that is the key issue. You are simply, in my view, not diversified in the S&P 500 if you put your money into the index today. And that's why this distinction between the S&P 7 and the S&P 493, and especially when it comes to earning revisions, is so critical at the moment.
I love you just rolled right into that turkey metaphor. Thank you for that. I mean, at some point, though, does the so-called turkey, I'm going to milk this for all I can, Torsten, get so big that it eats the plate, that there's at some point other companies and their earnings, they have to matter to the markets, to the economy, to the job market, or maybe not. Maybe they don't matter at all, and we should just every day talk about the same 7 or 8 companies.
It matters because, Brian, you and I need a balanced diet. That is the best advice we all get. And the balanced diet in finance is to have a diversified portfolio. That is not only in the Magnificent Seven. And in particular, when you look at profit margins, they've been revised up for the S&P, but it is all an upward revision because of the Max 7. The S&P 493 profit margins have been revised down since the beginning of the year. And if you really step back and think about what the consequences are of this, it is exactly that as an investor, there's just so much weight on my plate now on the Max 7. And it is a good time to take some chips off and begin to think about, well, what is it that I'm doing elsewhere? Because when you think about GDP, when you think about unemployment and inflation, the S&P 493 are more important.
You just rolled right with it. I love it. I'm going to switch gears a little bit. Yesterday, we led the show with this SEC filing from Michael Burry of The Big Short and how he may be betting against NVIDIA and Palantir. Again, we don't know. He was buying puts. That could be a hedge. We're not sure. But today, the Financial Times talked about Deutsche Bank having a potential or looking at the potentially shorting of some AI stocks. Is that impossible effectively right now? Would betting against these companies not only be foolhardy, but economically catastrophic because the cost of this?
Well, I think, as you also said earlier, there are now some other risks on the horizon, which, of course, is the IEEPA tariffs, which is both here in the short run, meaning including today, but, of course, in particular here over the next month or so. Though there's also the government shutdown. And the question is what these other risks do to valuations. And if we now on top of that have that we all agree that valuations for some of these companies in the Max 7, I mean, Tesla valuations at more than 300 on the trading PE ratio, it all tells you that there's just so much weight on a lot of these companies having in the overall basket. That means that it is not surprising that some people are beginning to look at this and say, is this the right risk reward that I'm taking relative to where this has been historically? And that doesn't mean that the risk cannot run on. And of course, we continue to see an expansion of the AI theme. But it does mean that as that process continues, it makes sense that some people are beginning to step back and think a little bit more about whether these valuations are not reaching very too high levels.